Be greedy when others are fearful and be fearful when others are greedy. That's a very common saying within the investment world. The problem is that greed and fear is just an emotion, right? It's nothing quantifiable. There are some metrics that try to quantify it. One very common metric is volatility. Now, to be more specific, implied volatility of the options market. So when we buy an option, we buy the right to buy that asset further out in the future for a specific price. Now, the more volatile an asset is, the more it goes up and down over time, the more likely it's going to reach prices that are very far away from the current price. And so when the market anticipates very high volatility, then the options are expensive. When the market anticipates that we are rather calm, then options tend to be cheap. But potentially this indicator, right, the VIX, the volatility index of the S&P 500, that could also be seen as a fear and greed index. When we are very high, then again, options are expensive, the market is fearful, and maybe we should buy when others are fearful, when the VIX is high. Now let's have a look at this. At the bottom, we've got the S&P 500 relative to US money supply. So we are completely ignoring how money is expanding over time. We are completely removing this from the price gains of the stock market. And that way it's easier to see the different crises. So over here, that's the dot-com bubble crash. Over here, that's the global financial crisis. And this week over here, that's COVID. And of course, we might have just started another crisis with the tariffs, with the trade war. Let's see how low this brings us. But let's have a look at how this compares to the VIX. This peaked, for example, in October of 1998. And yes, the price was short-term depressed. It did make sense to buy, but it only made sense to buy if you then intend to sell just a few weeks later, maybe half a year later. If you continued to hold, then there were prices that were much, much lower. The same is true for August of 2001 and also of July of 2002, right? Short-term, we might be in a local bottom and the VIX is high. Long-term, and with long-term, I just mean more than a couple of weeks. It's not necessarily the best indicator. For example, let's have a look at the global financial crisis. We did peak quite nicely with the first crash, but that was not necessarily the best time to enter because subsequently the S&P 500 fell by another 30% and the VIX at the time was actually lower. So to a degree, the VIX is simply a reflection of how much or how quickly we have already fallen, not necessarily of how much we will fall or how much we will recover. It's not necessarily a good indication of what's happening in the future. It's not necessarily a bottom indicator. So it's not that great to be used as a signal to buy when others are fearful. Yes, it does peak during a crash, but we can already see that in the price data, right? If the price simply drops quite quickly, it might make sense to sometimes buy, if valuations, of course, make sense. Now, again, we saw the VIX recently going up because the announcements of the tariffs had been a surprise to the market. But that doesn't mean that this is a good buying opportunity. In the past, days like this might have just started a prolonged bear market. And it can take time relative to monetary expansion until we actually get our money back. It can take more than 10 years. Instead of looking at how fearful the market is or how quickly it went down in the last few days, I think it's better to just look at valuations. And valuations are relative, right? They're relative to something else. If you buy stocks, that could be relative to the future earnings or to the anticipated future earnings. It could also be relative to the money supply, as in what's the market cap of the stock market to all of the money that's currently floating around. It could also be relative to the GDP. There's all kinds of metrics we can use. And that tells us a better story, whether or not something is currently cheap or expensive. Now at the top, again, we see the S&P 500 on a very long-term scale. So this starts in 1871, and this is a logarithmic scale, right? So on a linear scale, we don't really see what happened in the early days, but on a logarithmic scale, we do. And at the bottom, we see the S&P 500 again divided by US money supply, because the money base is expanding over time. Dollars devalue and thus companies get more expensive in US dollar terms, but not necessarily relative to the overall monetary base. But that's then the volatility that we live with, right? Stocks can drop by more than 70% relative to money supply, and they can also expand by almost 500%. Are we currently cheap or expensive in the grand scheme of things? To me, it looks like we are rather expensive. To me, it does not necessarily look like this is the best buy the dip opportunity. Otherwise, buying in January of 2001 would have also been a very nice buy the dip opportunity. But in reality, it really wasn't, right? In reality, the S&P 500 had another 60% to fall in the subsequent 8 years. Now here's the S&P 500 relative to its future earnings. Now this is a 7-year moving average because earnings fluctuate. That's called the Shiller PE ratio, the Shiller price to earnings ratio. This chart again is very, very long term. It starts in 1871. And again, this dip does look big on the micro. The volatility index did spike, but we can't look too much into the micro unless you are okay to sell in just a few weeks. But that might be a risky game, right? Because there is potential to fall much, much further. Historically, stocks were way cheaper relative to their earnings. Here's another way to look at valuations. This is the S&P 500 price to book value. Now, what's the book value of a company? It's the hard assets that a company owns, right? It might be intellectual property, but it also can be just machinery, right? Factories, etc. And of course, a company is worth more than the machines it holds, but that premium fluctuates. And at the bottom, right, in March of 2009, that premium was only 78%. Now it's 350%. Now check this out. This is the S&P 500 earnings yield. How much do we actually make in terms of dividends when we buy the entire S&P 500? And when we don't earn that much, that means that the S&P 500 is very expensive relative to what it makes. It's only at 3.8%. There aren't that many times where the stock market was that expensive, relatively speaking. Now, why do I make all of those complicated comparisons to future earnings or to the book value or to the monetary base? The reason is the monetary base is expanding over time. The dollar is worth less and less over time. And that is a very significant effect. Check this out. This is USM2, or the money supply in the US, and this tends to grow by on average 6.8% per annum. So this is the linear scale, this is the logarithmic scale. So the monetary base does expand quite consistently over time. And if your investment doesn't return at least 6.8% per annum, then you are falling behind relative to everything else that does expand at that rate. So that could be land, that could be stocks, that could be anything that's worth having long term. The official inflation rate is of course less than 6.8%. So here's the year-over-year inflation rate. So that's the one in green, and 6.8% as a reference is this horizontal line. So we rarely see officially measured inflation rates above that level. Most of the time we are below. Now what's reality? Is the inflation rate now only 3 or 4%, or is it 6.8%? The answer is, of course, it depends. It depends on what you want to buy. If you're buying something that gets cheaper and cheaper to produce over time, where technological progress helps reducing the cost, then the officially measured inflation rate, the consumer price index, matters. So if everything you're buying is just goods in the supermarket, or it's the next TV, or it's things of that nature, then of course the official inflation rate might be closer to reality. But if you're interested in buying things that are limited in supply, let's say exclusive education, or let's say land, or let's say medical treatment that has just been invented, then I think the 6.8% are much more realistic. If your wealth doesn't increase by 6.8% per annum, then it will get harder and harder to send your kids to Harvard, or to buy that house, or to get the latest and greatest medical advancements. But yeah, there is a case to be made that investing just in the S&P 500 does give real returns, right? This is the inflation adjusted S&P 500. Again, if you're just interested in buying bread, then you can double your money every 10 years or so. But if you're saving for something significant, then you're just keeping pace with the S&P 500. Then that's just a savings vehicle, nothing else. It's nothing to get ahead. And then of course, it does make sense to try to time the market somewhat. People say timing the market is not superior to timing the market, but people only say that when times have been good. I doubt that people in 2009, at the height of the global financial crisis, said the same thing. What we've got over here is the Dow Jones relative to the US GDP. And again, once we look at two things that both inflate with monetary expansion at the same rate, we tend to have a somewhat equal trading range. We tend to not see those long-term appreciating charts. We actually see how reality is. We actually see when things are cheap or expensive. And again, the current dip is not necessarily enough to be excited about. Now here is the S&P 500 relative to US GDP, a similar story. I'm not saying that this has to always be in the same trading range. There might be slight growth because US companies tend to internationalize more and more. And so the US GDP might not be a great measure relative to the US company profits, because more and more of US company profits are made outside of the US. But maybe then we've also got a bit more of a broad index. So this is now the total value of all publicly traded stocks relative to the US GDP. And here we've got all public and private corporations relative to US GDP. No matter what we look at, right, it always looks like stocks are not that cheap. Here's again the US stock market relative to the money supply. This starts in 1961. Buy the dip, they said. But then the dip can continue dipping. It has done so in the past. It can continue dipping for more than 10 years. And there is a case to be made that maybe a lot of people that became millionaires in the last 10, 15 years could now be overexposed to risk on assets because they've never seen any serious crash. I truly believe that most people of my generation, right, let's say 35 to 45 years of age, that made it recently, that maybe hit $1 million in wealth, most of those people are probably over allocated to risk on assets. Most people probably have too much Bitcoin and too much technology stocks, etc., because that is what worked for them in the past. But it might not work in the future. And a lot of people might lose their millionaire status or at least stay stuck at the current level for a while. Times can be tough for longer than most people anticipate. This here is 17 years. And this over here is 9 years. COVID really didn't do much in the grand scheme of things. The COVID crash isn't really worth mentioning. And I do believe that those trading ranges are pretty useful. Let's have a look at other countries. This is the US stock market, but here we've got the German stock market. So this is now the German DAX relative to the German GDP. Now, I'm originally from Germany, and so that's why I'm showing this. Are German stocks long-term outperforming the German GDP? Who knows? At least we can say that we are historically very high and that we have seen crashes of 70% in the past. Here's the Hang Seng relative to the Hong Kong GDP. Again, a trading range. I have lived in Hong Kong for more than 10 years, and Hong Kong stocks tend to be a bit cheaper compared to other stocks. Then the question, of course, is where do you believe will China and Hong Kong be in the next 10 years? Will it still be as relevant as it has been in the past? Will Hong Kong continue to grow? Or will the US continue to dominate in the future? That's, of course, very hard to say. And many people have already made their opinion on that. Now here's gold relative to US money supply. And unfortunately, it's not that cheap anymore either. We have seen higher prices in the past, but the current level hasn't been beaten too often. And the periods that we had been above this price level were much shorter compared to the periods where we had been below. So at some point, it might make sense to also take some profit in gold. It's not that easy to find an opportunity in this market. There's simply a lot of leverage in the system, right? The monetary base expands as people take on debt, right? And Ray Dalio talked about this, how the economic machine works, how debt tends to build up, and then at some point people can't pay back the debt. Then we see a deceleration of the economy, and then things tend to pick up again. It seems like now, in my opinion at least, looking at all of that data, it seems like we are quite highly levered, and asset prices shouldn't be as high as they currently are. And so what's the best strategy during times like this, right? When we still have the monetary expansion of 6.8%, and if we believe that risk on assets are going to contract, I think the best is to just look at the most risky of the asset classes and then bet on falling prices. We don't always have to buy, right? We can also short. We can make money when things are going down. This is what the billionaires are doing, and this is what we can do as small retail investors as well. We just have to be smart about this. We don't necessarily want to trade with the stock market because the stock market is already very efficient, and in there we've got all the hedge funds, etc. The easier market to beat, in my opinion, is crypto, right? It's to bet on falling altcoin prices, not necessarily falling Bitcoin prices, because Bitcoin is the most stable of the cryptocurrencies, but altcoins tend to underperform Bitcoin most of the time, and especially if the market as a whole is coming down, then the altcoins get absolutely decimated. And so yeah, this is what we are currently doing. Those are trades of the premium members of this channel. We are betting on falling altcoin prices, and most of those trades are going positive because of course the odds are in our favor, right? It's much easier to make money with falling prices than with rising prices because returns are concentrated, right? It's a winner takes most market, and especially when the market as a whole shrinks, then the altcoins tend to shrink even more. And so feel free to try it out without any risk, because there is a 1-week money back guarantee. In case you don't like premium, just message me within the first 7 days and I'll refund you 100%. There are my own trades that I'm sharing. I'm also sharing various tutorial videos on how to set this up in a way that is responsible, that we don't burn ourselves, that we don't get liquidated, etc. So the target is to grow our wealth consistently throughout this bear market, to then have more to deploy once prices are cheap again. If it's your first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. Helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.